Inflation, of course, continues to run hot in Canada, but how much of that is beyond our control and how much is homegrown? Here's a look by the numbers. The folks at Scotiabank ran the numbers on inflationary forces in Canada and determined that 50% of it is global in nature. That includes factors like U.S. inflation, high global commodity prices, and the effects of currency. Supply chain issues, also global in nature, are the cause of another 35% of the inflation in Canada. Government spending on pandemic support played a big role in our economy, but only added 0.45% to overall inflation. That number may seem small, but Scotiabank says it alone is responsible for 1.25% of the rate hikes that we have endured. The good news is that inflation is expected to drop to 4% next year and closer to the 2% target by 2024. It's impossible to say, of course, if Canada would still be struggling with inflation if the government had been less generous during pandemic, but it's clear that the price we're paying would be lower. Jean-Francois Perrault is chief economist at Scotiabank. Great to have you with us.
Oh, thank you.
So let's just start here with the impact that that spending had, and it does have this kind of outsized effect. Why is a full 1.25% of the hikes attributable to spending here at home?
Well, I mean, it's very simple, actually. You know, the relationship between economic activity and inflation is pretty low. But the relationship between the government spending and economic activity is pretty high. So you have to have a big impact on economic activity to have a modest impact on inflation. And because we've got this big impact from economic activity that transfers, you need a big impact on rates to ultimately impact inflation.
So is it possible, and I know this is the kind of thing economists hate, but is it possible for us to know what kind of state we'd be in if we hadn't spent that much? If we'd spent, say, 50 billion less or 100 billion less, could we run numbers and say we would be dealing with interest rates now at more like 3%?
Certainly. I mean, the reality is that it is unquestionable in our mind that a lower path of government spending would have generated less inflation and would have led to lower interest rates. That is absolutely certain. Now, exactly how much depends on the nature of the programs, depend on how they would have been calibrated, depends also in terms of when they would have pulled them back. But there's no doubt in our mind that lower government spending would have led to less inflation and less rates. Of
course, the flip side of that, JF, is lower government spending might have created a weaker economy. We might have seen more impacts on businesses and individuals. Again, it's a counterfactual. We don't know for sure. But are we seeing a stronger economy better able to withstand inflation and rate hikes because of the spending?
And that's a great question. And you know, the answer is probably yes. You know, a large part of the inflation that we're dealing with, as I said, and as you noted at the outset, is due to factors that are beyond our control. So to the extent that we're a little bit richer, you know, deposits are still very high in the Canadian bank account, balance sheets are still in pretty good shape. A lot of that is due to the stimulus that was rolled out that is still to some extent in bank accounts. That's actually helped us manage some of the inflationary consequences that are beyond our control. It's also created homegrown inflation, but it has had that very positive side effect of making it a little bit easier for us to handle the unprecedented increase in rates and, of course, the very high levels of inflation.
We do have, as you note in your analysis, a huge chunk of the inflationary forces that are beyond our control. They're global in nature. Some of them continue. You do have this kind of optimistic outlook that inflation does come back under control next year and the year beyond. What does that suggest about what you think happens to those global forces? They settle down?
Well, we've already seen a tremendous pullback in some of these things, right? So the cost of shipping is way down. Inventories are in a much better position. The cost of commodities has come down very significantly. So we know that some of these kind of supply constraints, some of these input cost pressures are back to where they were pre-pandemic or much lower than they were 6 or 7 months ago. And just as they contributed to inflation on the upside, they're going to work their way through into lower inflation as we go forward. So we know that's already happened. It's just a matter of it feeding into inflation. So there's a pretty high degree of confidence that that's going to happen. You know, is that going to lead to 4% inflation, 3% inflation, 5% inflation? That's uncertain. But it's almost certain that we are going to see lower inflation going forward because of those factors alone.
Not a ton of time, but do you see a recession in 2023? And if you do you see a deep one?
No, we see a recession, a minor one, you know, growth slightly below zero for a couple of 3 quarters. So by historical standards, something it's quite minor. And, you know, that's a function of the fact that rates at 4.25%, while they are, higher than we're experienced in the last year or so, they're not all that high from a historical perspective. Mm-hmm. And of course, you got the job market, which is still incredibly hot, and that provides a tremendous amount of cushion for households to be able to manage some of the shocks that we are experiencing right now and that we will experience.
So good to have you. Appreciate your time.
Thank you.
Jean-Francois Perrault is chief economist at Scotiabank. Well, while costs do continue to rise, a key pressure, of course, is mortgages. More specifically, we look at mortgage affordability, and that is hitting multi-decade lows. Kyle Dahms is an economist with National Bank of Canada with a report recently, Kyle, that was a little alarming in the sense of the proportion, the percentage of income going to mortgages. This is at record levels.
Yeah, the proportion of mortgages is now at about 70% of actually the proportion of income going to mortgages at 70%, which is something we haven't seen since the 1980s. And as we all remember back then, mortgage rates were much higher than they are now. So obviously the price component of going into that equation has become a bit of an issue.
So let's just characterize that. I mean, I've got this number in my head, Kyle, that affordability is 30% of your income goes to pay your housing costs. When you're talking about something closer to 70%, what does that suggest about what's happening to these people?
Well, it certainly suggests that households are more strained in regards to getting that home, right? And obviously, so as those home prices have risen in the past few years, you've had to attribute more spending towards that same house, right? So I think overall what we're seeing in the current trend is an unaffordable market. But what we're also seeing is that this could be reaching a peak in a certain sense.
So, of course, we did hear from the Bank of Canada, they raised rates again, but there is this subtle signal that they're close to done. They're watching the data, but if they see the kind of slowdown that I guess what they hope to see, I hate to put it that way, but they will maybe stay still at the January meeting. If this is the height of it, how long do you figure we stay here? In other words, if people are trying to manage their budgets at this level, can we give any sense of how long it will stay at this level?
So currently in our forecast for interest rates, we see the Bank of Canada start to actually lower rates in the fourth quarter of next year. So certainly we expect that there's going to be some stability for the next few quarters. And in a sense, we might actually see mortgage interest rates start to slowly decline in the next few quarters as well. So from that perspective, housing affordability might actually improve. The other factor that we're seeing right now is obviously with these higher mortgage interest rates and these higher, the rate hikes that have occurred already, home prices are actually starting to decline. So in our latest report, we had a decline of about 1.1% in home prices, which is the first time that's occurred in the last 3 years. And we expect that home prices could decline up to 15% in the next year.
So a key part of all of this, JF just alluded to it, and we know the central bank is watching it, is the strength of the labor market. It's been pretty strong, so people's jobs and incomes, if they're safe, makes affordability at least a more rational prospect. What's your expectation for what happens on that front?
Certainly, we have in our current outlook a labor market that remains somewhat strong, but we do see the unemployment rate start to tick up in the next year as the economy starts to slow down due to all the tightening that's occurred in regards to monetary policy. So as that economy slows, we do see an uptick in unemployment. And as such, that's what's kind of feeding into our home price decline at this point in time.
So just a real quick one here. We know that there may be a recession ahead. If affordability really deteriorates and home prices drop, we know that a real estate-led recession can be quite harmful for people. Are we expecting that at all, or are you also in the mild recession camp?
We actually don't have a recession in our base forecast. We are seeing a significant slowdown next year, so growth around, I want to say 0.7, 0.8%. Mm-hmm. So right now, not a housing-led recession or anything like that, but housing is about 12% of the Canadian economy if we look overall at its, and that number can vary, obviously, but so any kind of significant decline in that sector has a whole bunch of knock-on effects, whether it be in financials or construction and all the tangential sectors related to that.
Kyle, so good to have you. Appreciate it. Nice to end on a positive note.
Thank you.
Kyle Dahms is an economist with National Bank of Canada. Coming up, a tragic death leads to learnings that should keep others from harm, but only if the warnings are heeded. That's still ahead. But first, this. It's hard to imagine a clearer sign of the times than Dollarama's resounding success. The discount or value chain said that its sales grew even more than it expected as shoppers seek out cheaper places to buy food and other items. Dollar stores aren't what they used to be. Most categories are priced anywhere from $1.25 to $2.50, and some prices are as high as $5, something the chain says it can't control as suppliers raise prices, giving new meaning to the phrase, passing the buck. We're back after this.